Hey everybody, I'm going to be covering universal life. It can be kind of confusing. I hope this helps you pass your life insurance licensing course. If you have any questions, reach out to me at jve@thejve.com. That's jve@thejve.com. Let's get into some universal life. Okay, universal life can be kind of confusing. So I'm going to go over what it is for you guys for your life insurance exam prep. Okay, so universal life, it's kind of like a flexible premium, adjustable life. All right, so people can adjust the premium, or the premium can be flexible throughout the life of the policy, bottom line. So what it does, it gives the owner the ability to adjust the premium, cash value, death benefit, and offers a few different death benefit options. So like the person can lower the death benefit. If they increase the death benefit, then usually there is some sort of evidence of insurability required. All right, so what that means is if they want to increase the death benefit of the policy, they're going to have to go typically through underwriting again. Some insurance companies have an option on their universal life where they say like every 10 years you can increase the death benefit, $30,000 without having to go through underwriting again or something like that. There are a lot of different options, and universal life can be kind of confusing. Okay, so the policy owner can increase and decrease the premium paid in to it, essentially, like if they pay monthly or annually. And the change in what they pay essentially dictates how long the policy will stay enforced based on that monthly payment. So it's kind of a mix between whole life and term. And when I started in the industry, the guy who taught us about it he called it a cash value term policy. So there's a minimum premium in a universal life that maintains the policy year to year, and a target premium that's intended to keep the policy active for its entire lifetime. So I'm going to show you exactly what I mean by that. This is just a rough graph here of a universal life example of how the cash value, the premium, and the cost of insurance inside affect it. So essentially, the universal life internally, the cost of the policy is an annually renewable term. So every single year, the cost of maintaining that policy increases. So for whatever death benefit the policy has, every single year, the amount of money that essentially has to be paid by the policy owner or the payer increases. Now, a whole life policy, the internal cost is the same throughout the whole life of the policy. It's averaged out throughout the entire lifetime of the policy. The universal life, it's an annually renewable term. So say it's, $10 a month one year, and then $15 a month the next year, and then $21 a month the next year, just to maintain that policy. So that's the cost of insurance that you see with the blue line right here. So it goes up, essentially it goes up linearly, but it's really going to probably go up exponentially. But this is just an example that shows as the cost of insurance, it shows the cost of insurance increasing over time. Money, time, okay? So if someone had just made the minimum payment, the minimum premium, it's going to maintain the policy year to year. So every year the person just makes whatever the cost of insurance is, and the policy will stay in force. It's essentially like an annual renewable term, but there will be no cash value growth here. So what you're seeing here is, right here is the premium. So say this person's paying the target premium right here. See the red line. So they're paying the target premium, which is essentially the premium that will be needed to be paid to keep the policy in force for its lifetime. Right, so, or for the lifetime of the client, or however long they want to keep it in force for. All right, so say they're like, I want this until age 90. So we're going to assume that this is age 90 right here for the client. So the person pays this much. Now, as you can see in the beginning, the cost of insurance is much lower than the premium. So the cash value is going to start increasing. Okay, this is the cash value inside the policy. Now, once the premium equals the cost of insurance, the cash, and it keeps going on after here, the cash value starts to go down, because what happens is the premium is actually becomes lower than the cost of insurance. So the cash value is going to decrease as some of the cash value gets eaten up to cover this difference between the cost of insurance and the premium of the policy. Okay, so they're overpaying up front to underpay later. Now, the reason that cash value helps is because, like I said, right here at this breaking point, the difference here between the premium and the cost of insurance has to be taken up by this cash value. And I know it's not perfectly even, but you'll see at age 90 or whatever year they decide, that the last year they want the policy to stay in force until, the cost of insurance it has eaten up all the cash value based on the premium that they're paying, and at this point the policy lapses. So universal life does have cash value, but it's not really the type of policy that you're going to want to dip into the cash value for, because it's going to impact how long the policy is in force for unless you start making extra payments or pay back that premium. Pay back the cash value that you took out. So you can do a surrender of the cash value. So you can do a partial withdrawal or a partial surrender of the policy cash value. However, there may be a charge each time you personally withdraw the cash value. So in this case, you're making your premium payment, and the cost of insurance is automatically offset by the premium and the cash value. But if you're like, I want to withdraw some of that cash value separately, there may be costs involved. And if you withdraw more than what you paid in, then obviously it could be a taxable event, right? Because then you're withdrawing more than you paid in, and that becomes a gain that would be taxed. Now, the death benefit will be reduced by the amount of any partial surrender. So if you withdraw any amount of this cash value early, then the death benefit of the policy is reduced by that. So this is just a quick little example of how Universal Life works internally with cash value. All right, so if an agent sells Universal Life because of the cash value, it's kind of a fallacy. There's a lot of retirement plans out there that use indexed Universal Life, which is it is not a retirement plan. What happens is when the person gets to age 80, the cost of the policy, or his 70s and 80s, or even their 90s, the internal cost of the policy is going to be so insanely high that it's just going to start whacking that cash value away. So any money that has been saved for retirement, it's going to get it's a dangerous shoot to step in. But that's a total other story. So one thing I'm going to go over here in Universal Life, there's two death benefit options. You have a level death benefit right here and an increasing death benefit. So I know the level death benefit, you see the red here, how it's actually increasing, but what happens is there's a thing called an IRS corridor. So the IRS said that the cash value can never exceed the death benefit, or the death benefit always has to be a certain amount higher than the cash value. It's built into the policy. I don't know exactly how they figure out, but all you really have to know is that the cash value can't exceed the death benefit in a universal life policy, or really any life insurance policy. So what happens here is as the cash value increases, it gets to a certain point where the death benefit has to naturally increase otherwise. Okay, so in a level death benefit option, the death benefit will stay level, and it'll start increasing if the cash value starts approaching being above what the death benefit is. Okay, now Plan B is an increasing death benefit option. So with the increasing death benefit option, it includes the annual cash value in the increase in death benefit. So the death benefit will gradually increase year by year, the amount that the cash value increases. So if the cash value increases $10, the death benefit increases $10. As you can see in Plan A, the death benefit remains level and then only increases to match that IRS corridor. Here, the death benefit increases regardless, or at any addition in cash value, the death benefit is going to increase. So obviously, this is going to end up being a higher death benefit over time, right? Because say this is a $100,000 death benefit, the cash value has to get probably around like $95,000 before the death benefit starts to increase. Here, if you start here at 100,000, once you get to 90,000 in cash value, you're going to be at 190,000 death benefit, as opposed to here, you're still probably right around 100,000. So obviously, the premium on an increasing death benefit option, Universal Life, is going to be more expensive because it's just the company's going to pay out a higher death benefit. They take more risk to pay out more money to the same client. So yes, this one does have a higher premium, and this one would have a lower premium, but those are the two death benefit options. Okay, so that is a summary of Universal Life for you. I hope this helps for your life insurance exam prep. If you have any questions, please reach out to me. JVE@thejve.com. That's JVE@thejve.com.